I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure here is looking pretty clean because I had a lot of options that expired on Friday last week, primarily in my favor. It was pretty good. So yeah, that's the position disclosure there. All right, let's jump in and talk about the market. Okay, so SPYs are down. They're actually up a little bit from where we closed. So including the little after hours bounce, we're off 0.36%. The Qs here are also bouncing 40 cents or so, 50 cents after hours. But even with that, they're down 1.1%. Despite both Zoom and HIMS trading lower, or at least last I checked, on their earnings reports. And the IWM's up 30 cents after hours, but is still down 0.6%. So, yeah, I mean, a little bit of a two-day bloodbath out there, a little bit. 5-minute chart up here. You can see Friday. We don't do afternoon meetings on Friday, but you can see here the heavy sell day on Friday. The gap up this morning, which was faded, no surprise. I wanted a little bit more of a bounce to short that gap up myself, but they faded it all the same, and heavier and faster than I would have expected off of this low, to be honest. And then that was actually a very viable low. We called that out really well as a team today. We called out the index long, the Palantir long, the Meta long, like a whole bunch of stocks at the absolute low for bounce trades. So that was pretty solid. We worked our way higher here, tried to create a lower high. I remember saying into this pullback that I'd be surprised if we make new lows. We pulled back even deeper than I would have expected, though, yet there was no new low, a little bit of a higher high. Then we broke up above the 10-15 bounce pivot, and then kind of did nothing really for the rest of the day. Rolled around that SPY 600 for the rest of the day primarily, and then we sold into the close when MOCs hit to almost close at lows and close below SPY 600, which is not what you want to see if you're a bull. Q's pretty much the exact same story, and the IWM pretty much the exact same story as far as the intraday goes. Let's have a look at the daily chart. So, I mean, look, we had spent, let's give our team some credit here. We had spent a lot of the last couple weeks talking about, as we get into the OPEX period, that would be the time when the market dynamics would change in such a way in the second half of February, where you get into weaker seasonality with the VIX negative gamma that could feed on itself, and then a roll off of at least some of the positive gamma at the SPX level, plus with how Mag 7 was primarily looking pretty bad, that if we could get to a point where the dynamics allow us to loosen up, then we could sell. And that is what happened. Pretty strong market going into that. We were technically breaking out as we were getting above 610. And I remember just kind of saying it over and over and over again, like, hey, I know the market technicals here are breaking out, but there's a lot of stuff under the surface that we should be really concerned about, and there's a much higher probability of a failed breakout than usual. And now we are confirming from the market price action here that our thought process was pretty much exactly correct. So I know for myself, in that final thrust higher, I had some long positions hit my targets, and I use that as an opportunity to liquidate those long positions. And then typically, with some of my kind of swing longs, if they get back below my target, you would see me reinitiate those positions. And I really did not do that this time around. So even as the market was beginning to technically break out, I found myself actually net short up there, and that made for Friday and today to be decent paydays off of those short positions. So we had a full-on false breakout here. We got above 610. We held above that long enough to get everybody out there looking and sounding really bullish, except for us. Then we lost that 610. We lost the Thursday low, which was that 603.20 that we were looking at as like a really important spot for momentum bulls to hold. So we lost that. $600 was previously a really important inflection point where I had been saying above 600 we were like neutral bullish. Below 600, we're more neutral. Well, now we even closed below 600 today, just off of this 2-day pullback. Next support zones to pay attention to. You have the 2 pivot lows. It's a little bit loose. We have the 2 pivot lows from the news gap down days on. Those are both Mondays, January 27th and February 3rd. So that creates a little bit of a support zone between like 590 and 595. The really important level for the SPYs, though, is still all the way down to 580. So we're still $18 off that. We'll see if it ends up getting tested in this current market pullback or not. NVIDIA is probably going to have a lot to do with whether the bearishness of this false breakout continues or not. Popping over to the Qs, that 530 area had been really important technically. We spent a lot of time talking about it. We got above it. We noted that this was a bull flag. We noted that this was a potential continuation hammer into the equilibrium area. But despite the bullishness of the technicals, I know I was continuing to warn about the bearish market dynamics, which I thought might be setting us up for a false breakout. It's, again, exactly what happened. We lost that 530 area. Today we even were testing like this 522 zone, which was a little bit of support. We lost that. But bigger, more important support is down at 510. 510 is a really big level for the Qs. Even here, I know that these 2 candles are pretty damning, but the big picture of this market is actually still fairly neutral, despite these kind of bearish engulfing candles. If you lose 510 big picture, then you start to have a much bigger problem, technically speaking. But these are, Friday's candle especially, and then we got some follow-up through today, is what I like to call a penalty box candle for the market. It's a bearish engulfing where even if the market technicals aren't bearish, the candlesticks themselves certainly are. And coming into today, our game plan, because we had a little bit of a gap up, was definitely not to buy the gap up, despite the fact that short-term tactical closed in the green on Friday, which usually indicates an opportunity. Doesn't necessarily mean to buy. That's what I always say. Short-term tactical being in the green does not always mean to buy, but it certainly means don't short. But that gap up this morning satisfied some of that short-term tactical. So I know that I was looking for or hoping for a little bit more of a bounce, maybe to like 604 to really reinitiate some shorts, but I already had shorts on, so not the end of the world that I didn't get the 604 price in the SPYs. But then what we discussed in the morning meeting was that the higher probability situations for today were either going to be like a rest day, like an inside day that could set us up for an inside and down tomorrow, or some degree of downside continuation. But we also specifically discussed how if we get a second red candle today, it's probably not going to be as big as Friday's. We could get some downside continuation, but I said I doubt we'll get like a doubling of Friday's move. Friday's move in the SPYs was $10. So even if you start from the gap up area at like 602, that would bring us down to 692. That was also very unlikely. So the most likely situation is actually what played out today, which is that gap up got faded a bit throughout the day. We closed a little bit weak. We got a little bit of downside continuation today. But we are at the same time starting to approach some extreme downside extension, at least on a very short time frame. So that's how we always want to be thinking about the market, right? You can be bearish about the market, but at a certain degree of downside extension, it's actually a much better risk reward to be looking for short-term longs than it is short continuation trades, even if you have the potential of bigger picture downside continuation, even if that's your expectation. So as you start to get into like a day 3, which would happen tomorrow, if you can get like a day 3 with $10 plus of extension on some of these indexes from the ADMA on the daily, with short-term tactical in the in the green again, then that actually could be a little bit of an indication to come in on the other side of the market. But broadly speaking, unless NVIDIA comes through and really saves the market, there's a good chance that we could really continue to be bearish here throughout the month of February and into at least the first week, maybe 2 weeks of March, and then we can reassess things as we approach March OPEX, which is a quarterly OPEX and a really big one. So for the moment, market just continuing to be short-term bearish, Bigger picture, I would say SPY's neutral. I would say Q's neutral, and I would say IWM actually outright bearish at this point. But the the daily technicals, the daily candles are confirming increased bearishness. But let's pay attention to extension. So today the SPYs right now are trading at like 597.60 with the ADMA at 605 ish. That'll be even lower tomorrow. So you probably would need a gap. You would need the market to trade down to like 590. I'm guessing we can look at it tomorrow morning, but like 593, 594 on that day 3 for me to really consider going the other way, at least short time frame for like a bounce back trade. The Qs actually closed $10 down from the ADMA on the daily. So they actually closed right at that like extreme downside extension point. Obviously, the ADMA will be a little bit lower tomorrow, so we probably need these Qs to be trading more like, I don't know, 518, 517 to really be in an area to consider going long on the day 3 trade. I'll be honest, I'm actually still pretty bearish overall on this market to the point where the usual like $10 a downside extension where I might start to nibble to the long side for the moment isn't really enough for me. You know, if I see these Qs more like $13 to $16 of extension, then I'm probably gonna have to say to myself, all right, let's look to build into a little bit of a short-term long for a bounce back because this downside extension is getting really extreme. But at least for this week in February, NVIDIA aside, after OPEX, this is really an opportunity window for the market to really stay weak and to continue to the downside. And we know that the CTAs are still selling. Vol control is sellers on higher realized vol, which they didn't really get that today. Retail had been coming in and attempting to buy all these tiny dips, right? So we know that there was a boatload of retail buying on like January 27th and February 3rd. So you start to lose those lows, all that retail that's been trying to come in and buy every tiny dip, they start being out of the money as well. And that's at the same time as they're probably running out of cash to be able to buy, and at the same time as we are approaching tax season, where after a really strong calendar year, there's probably going to be decent tax bills that are due for some of these market participants, where they don't have that same cash to be able to buy these really small dips that they did, or even worse, they might even have to liquidate positions in order to pay the tax man or tax woman for last calendar year. So I broadly speaking still don't like this market for this week. We'll obviously see what happens with NVIDIA, if NVIDIA can save the market or not. I do think that the risk on NVIDIA is to the downside, kind of what David and Billy were talking about a little bit in the VTF right before the meeting started. Like, NVIDIA is just so priced to perfection that like an earnings report that's in line probably leads to a sell-off. I know NVIDIA is a bit off highs now, but so we'll take that as it comes on Wednesday. We still got a couple days before we actually get there. But yeah, I mean, bottom line, market not looking great from these last couple trading sessions, and we'll see if we can get continued follow through throughout the week or not. It's pretty much all I got. From a trading perspective today, I think that the best call outs were off this low. I mentioned it already real quick when I was reviewing the market. This move lower on the 5-minute happened so early in the day that I don't think it was enough time to really satisfy that short-term tactical being in the green. So let me pull up Pat's note here real quick. So you can see short-term tactical closing the green. I missed the old way that they did this chart where you could see the historical short-term tactical going back at least like a month or whatever it was, but I don't make it. So short-term tactical closed in that green zone. It is possible, and I said this in the morning meeting, we've seen this happen, where short-term tactical closes in the green or closes in the red, sometimes for a few days in a row. 3 days in a row 2 days in a row is not uncommon at all. 3 days in a row we see happen in bigger market moves. 4 days, I think, becomes extremely rare. I think we've maybe only ever seen that like once or twice, and 5 days I don't think we've ever seen. Or maybe we did during COVID, but I wasn't looking at short-term tactical back at that point during COVID. So at least in my time that I've been watching it, which has been the last few years that Pat's been getting it in his note, I don't think we've ever seen it really be consistently in the green zone or in the red zone for 4 or 5 days in a row. So when you do get that 2 days in a row or 3 days in a row, though, there's a pretty consistent pattern on what the market does. So typically, what happens is you get some sort of gap or you get some sort of directional move in the beginning of the day, opposite to the way the market had been trading. So in this case, we closed very poorly on Friday. So you get a gap up this morning, or you get some sort of upside price action at the beginning of the day this morning. That begins to satisfy that short-term tactical. But from what I've always seen, it takes like a couple hours to really satisfy it. So you get the market to kind of move sideways here, till 11 or 12, and then you see the roll down, the pressure start to occur because you had 2 to 3 hours of time correction that satisfies that short-term tactical. It reinvigorates the sellers. Then you get the push down where you get the weak close, and then short-term tactical close. In this case, would close in the green for a second day, sometimes even a third day that happens. Like I said, we've basically never seen that happen for 4 or 5 days. So today, when we gapped up, that does help satisfy that short-term tactical a little bit, but we instantly sold down well through yesterday's low. Like yesterday's low was Friday's low was like 599.50. We traded all the way down to 596.50. So I'm saying to myself, I know that on a day two. So first of all, I don't want to say I know, because we work in a game of probabilities, and if you trade long enough, anything that can happen will happen. But generally speaking, we know that if you're going to be selling down this hard, this fast after short-term tactical closed in the green, it's not really sustainable. It's not really a sustainable move, to the point where, as someone who's trying to be bearish right now, I don't want to see this move in the beginning of the day, because I know that this move is not sustainable as someone who is a bear. I would actually, even though I was net short this morning, I would rather see the market move sideways for 2.5 hours and then roll down, because that's much more sustainable than seeing this heavy momentum selling coming out immediately off the open. So for me, into this down move, it's like, okay, great, it's happening and I'm short, so I'm making money, I'll take it, but I'm going to be covering my shorts a little bit more aggressively, and at a certain point, this is probably going to lead to a short-term buying opportunity, because this is not going to be sustainable. And then as someone who's a bear right now, what I don't want to see is like an okay close. Because if I got an okay close after this heavy selling in the beginning of the day, what kind of daily candle am I going to get? I'm going to get a big downside tail. And then that might be actually confirming that my bearish thesis is wrong, or it needs a lot more time to play out, and we get a little bit of a bounce back off that. So even as someone who is bearish and making money on this opening move, it's really not what I wanted to see, because it's not sustainable. So I was like, all right, let me cover my shorts a little bit more aggressively. Let me look for some long opportunities. So I did buy TNA pretty aggressively into this down move. I know I didn't really take any of the other long call outs that we were looking at that period of time, and I probably should have and should have and would have and could have, or definitely four-letter words in trading. But my big picture mentality of still being pretty bearish got in the way of me kind of looking for more of shorter term profits in some of the names that we called out for RDR long opportunities for today, especially into this sort of a down move. But I was buying TNA pretty aggressively, and I made decent money in that. It's actually my most profitable long on the day is TNA. I called out Palantir. It was a little bit tricky because it kind of broke lows here a couple times. We called out Palantir as a long under $90. That eventually gave a $4 bounce move off of that. We called out Meta off of this low, and I know that one shook out as well, giving a new low. But we also, someone had brought up Robinhood at one point, and I was like, I like Robinhood, but this pattern's a little bit bearish. You might be able to buy this on the way up. That one eventually worked. TTD was probably the best call of the day as far as the RDR situation. I think some news came out in TTD as well. So that one ended up working out pretty well. Reddit also ended up into this capitulation kind of low here, uh, breached through the 160 support, 158 to 160 support zone that we were talking about, but in a manner that was unsustainable. So that also led to a pretty good buy. Walmart eventually rounded up. I remember looking at this around 11 o'clock to see if this could be a bounce trade. So there were actually some pretty good short-term bounce trades. I wasn't aggressive in taking them, even if I was able to call a bunch of them out, just because, like I said, the big picture I think was just a little bit too much in my head, and I'm really trying to be patient on some of these long positions. I do have a list of names that when I feel a little bit more confident about this market sell off being done, at least in the short term, that I want to get myself involved in. And there's a chance I even miss it if I'm being too conservative. But it just actually is what it is at that point. So overall, I think it was a pretty good day. I think we communicated really well today. I think we had a really good feel and grasp on how the market was trading, and that led to some really good calls. I think on both sides of the market. And now we will see what happens with this big picture. So that is all that I've got. I am happy, like always, to answer any questions that anybody has. So scrolling up in the VTF, one from Pete just before the meeting started. On hammer candles, do you care if it is red or green? I don't. I don't. I know some people do. Some people want to see, like the candle actually be green. When you're looking at a hammer, though, the body of the candle being smaller than the tail means to me that the color of the candle is relatively irrelevant, because the point is that sellers were in control in the early portion of that period and buyers were in control by the close of that period, and therefore buyers are in control at the end, so you're expecting them to give some degree of upside continuation. So whether that candle happened to close red or green by 10 cents or whatever doesn't really matter too much to me. It's more about the shape of the candle. And second question, do you keep your stops in extended hours only during normal hours? Stops don't work in extended hours. So that's important to know. Stops don't work in extended hours. Market orders don't work in extended hours. And certain ECNs go offline at certain points of the day. Like you can't execute through New York after 4 o'clock. I'm trying to remember. I know they changed some of the times, some of the closings. Like NASDAQ and ARCA, which is what I primarily use, I think continue all the way to 8 p.m. But I think maybe Edge and Bats close at 6. I don't 100% remember. But if you're trading after hours, you certainly want to make sure that you know what order types work and what don't work after hours. And for anyone who is newer on the team, I generally do not suggest that you trade after hours because there are no stops, and that makes it difficult to manage risk. And if you're involved in something that has zero liquidity because it's pre or post market, and that happens a lot, you could find yourself getting trapped in something. So certainly be really careful on any pre or post market trading that you might do. Yeah, we got HIMS out after hours. It's trading down on good numbers from what I see. Stock is just too expensive into the report. It's similar like that Carvana. Carvana's another one. The Carvana numbers I thought were pretty good, but they just have destroyed this thing ever since that report. It was just too expensive, and the market has really taken a lot of these expensive stocks to the woodshed in this recent pullback as it started. Obviously, Palantir being another one. The degree of the continuation in Palantir today on the downside was kind of impressive. Any update on the positioning numbers? I haven't seen anything new throughout the day. I know Bill gave us some stuff pre-market that you can look at in the VTF. Riot? Is Riot out? I'm not sure. Looks like it's trading up really small. If anybody's got the numbers and wants to post them, you can. From Richard, what do I think of Alibaba and Uvixi? So I like Alibaba very broadly. I like Alibaba very broadly. It gave an incredible upside move. I still like the China theme trade. I'm being patient on re-entering it. It did get all the way down to the 80 MA here at like 128. In theory, you could start to nibble on some long here again if you wanted to get back involved. I'm going to be a little bit more patient than that. I want to just get through a little bit more of this market kind of bearish cycle that we're in right now. And, if I could get like an Alibaba look around 120, I probably would take a look at that, somewhere between in the midpoint of the 8 and 21 EMA. But for the moment, I'm just going to continue to be patient, even if I like the names, broadly speaking. I'm out of all my China exposure right now in my active trading account. Um, so yeah, and what do I think about UVixie? One thing you want to remember about UVixie is that it's a terrible, terrible ETF, and it's not something that you ever want to own for the long term because it decays. The product is designed to only go down in the long run. With that said, when you get spikes in volatility, it's basically just it's a levered VIX ETN. It can go up very, very quickly. You could see that here, like with this quick 2-day move that we had, where it went from 1850 to 29 core. That's a pretty big move. Or does anyone remember back in August when this thing in just a few days went from $24 to $65? So when this thing moves, it can move very, very quickly to the upside. I do like the idea of having some VIX long exposure, whether it's through outright VIX calls or just the structure of the VIX right now. As the market continues to move down, buying in the VIX can easily just feed on itself. So I like the idea of having some VIX exposure, but if you're doing it through this UVixie, you just got to keep in mind that these are primarily short-term momentum trades that you're involved for a day to a week at the most. If you're, there might be some rare exceptions to this, like if we got a real legitimate, COVID crash type of thing. But outside of that, if you're in like a UVixie ETF long for over a week, you're overstaying your welcome. I missed Tate. What about QVC? What about it? QRTEA changed its symbol to QVCGA. Is that it? QVCGA? Oh yeah, it's brand new today. So, whatever. Change its symbol, and then you had that QVC GB. The Class B shares went bonkers today, up to $19. There's no liquidity in that thing. I don't know. It's got earnings this week, so whatever. I've had a position in this. It's not really been a position that I've been able to trade because it doesn't move. But I think that if they announce a buyback, the stock could wake up and squeeze. So that's why I'm in it. From Varun on Boeing. Boeing, Nike, can the relative outperformance continue? Or is it a one-day wonder? Yeah, I mean, so what was strong today, before we answer your question directly, consumer staples, right? Defensive plays, consumer staples were super, super strong. I remember at one point looking at like AT&T today when it was at highs. It's like, wow, AT&T, this thing has just been on fire recently. Coca-Cola has been on fire recently, really strong. Consumer staples tend to obviously hold in recessions and bear markets and all that stuff, but in true bear markets, they end up selling everything. So the fact that there's anything going up, would signal to me that this is not like a true bear market that we're entering. I think that this is more like a market correction plus some volatility, and then that we could maybe go into a bear market a little bit more down the road if we get some sort of a growth scare, which I know Charlie McElligot's been talking a lot about the potential of a growth scare coming into the market that's feeding on itself from some of the administration's policies. So we'll see if that happens or not. But he's also calling for more like spring or summer for that. For the moment, I think with this current pullback in the market that we're dealing with, could see a 5% pullback, a 7% pullback. You could even see us go 10% plus a little bit, but I wouldn't expect like I don't expect this immediate down move that we're in right now to turn into a full-fledged bear market, which is where they would sell everything. So there are pockets of strength out there. Boeing, I don't know. I don't know. Does anyone else like get a little nervous now every time they fly on a Boeing airplane? I know I do. I don't get nervous about it, to be honest, but I'm like, ugh, I wish I wasn't on a Boeing because they're a little slipshod sometimes in their manufacturing. Put me on something else. But yeah, I mean, some relative strength in Boeing. I don't really have anything to say about it. Nike was on our buy list today because of the upgrade. So Nike got upgraded this morning. We had it on our buy list for a long versus 78. I'm not sure if anybody caught it, but trade obviously worked great just with some relative strength there, plus the upgrade that happened. What does RDR stand for? RDR stands for Red Dog Reversal. Sometimes people will refer to it as a DOO. It's the same thing. Derrick Oldensmith overthrow. RDR, Red Dog Reversal, is the same thing as a DOO, which is the same thing as an 80-20 trade. Just Scott Ruther here at T3 renamed the trade from an 80-20 trade to a Red Dog Reversal. He renamed it after himself. But it can be a pretty good trade. So what is it? It's basically when you have multiple down days in a row. Typically, you've had at least 2, if not 3 down days in a row. The RDR trade is when on the next day, on your day 3 or your day 4 or your day 5, a stock trades through the previous day's low and then trades back up through the previous day's low. And the way that he traditionally teaches to execute that trade would be to buy back through the previous day's low as your entry price, with today's low as your stop loss. The idea being that if you've had multiple down days in a row, you're probably looking at a stock that's extended, and then you have a stock that's extended that's breaking new lows. So you're getting momentum chasers and things like that to come in, or you're getting other people who are getting stopped out of that stock at that new low. And then when the smarter real dip buyers come in because the stock is really extended on that day 3, 4, 5, whatever, it gets it back through the previous day's low. And now the stock can move up even more easily because more people got shaken out. There's less people to sell on the way up. And then you can look for a bounce back. That bounce back, usually what I look for is a bounce back to the 80 MA on whatever time frame that I'm looking at, which is typically going to be a daily chart. So there was a bunch of stocks out there that we looked at today. I didn't really take many of them because I was nervous about the market, but there are a bunch of stocks out there that kind of set up with this RDR setup. So one being the trade desk. This thing was on a day 7 to the downside. Broke through yesterday's low. Actually did it right off the open. So if you tried it off the open, you would have gotten shaken out initially, and then it worked on the second try. Came back through yesterday's low, so you'd be buying it, on this green bar here at 10 a.m. or so at like 71.60-ish. Stop loss is the low of the day, which is 70.43, and then you're looking for upside continuation. Really, again, upside continuation on the daily chart, ideally back to the 80 MA on the daily. Or Reddit was another one that I was looking at. It was a big day 3 down this morning on the break of yesterday's low. Right, 2 big down days in a row. So today's day 3. Lots of extension from the 80 MA on the daily chart, so I have a decent reward profile, and then you could buy it back through yesterday's low versus today's low. So that's how he trades it. It's actually not how I usually trade it, though. The way that I like to trade it is I already know that this is this day 3 to the downside, so I like to anticipate that it could snap back through the previous day's low before it even happens. So knowing that the stock is really extended to the downside on the daily chart, I can come in on the small time frame and look for more of like a small time frame execution setup to be able to take advantage of the big picture RDR should it actually occur. So instead of buying Reddit at 11:30 back through yesterday's low, so basically 161.88, with a stop loss all the way down to 154.15. The problem with doing this on the daily chart, the way that Scott teaches it, in my opinion, is that sometimes the risk is just way too big. I'm not buying Reddit at whatever price I just said, like 162 with a stop loss. I'm not taking $8 risk in Reddit on a counter trend trade, even if the reward profile on that trade is a snapback to like 180. So it's still actually an okay risk reward. Um, trying to get like $18 of upside, it'll probably end up being less than that because the ADMA continues to work its way lower off of your, whatever I just said, $8 of risk or whatever. But I would much rather have recognized what we had already recognized with where the market was, plus this capitulation candle on this high volume coming in with this huge downside extension at the same time as the market, and then like buy this doji here. I would rather be buying 156 from seeing this high volume doji come in versus lows, recognizing it's a counter trend trade on multiple time frames. So I want to book my profit initially based on the 5-minute chart into the 80 EMA, into the 21 EMA on that 5-minute chart, book a little bit of profit for myself, but also recognize the daily chart has so much extension, and if the daily chart gives an RDR, sure, book some profit real quick to get the risk off the table. I'm always a supporter of that, but hold a good percentage of your position as well in case your little 5-minute capitulation trade that you're looking at turns into a bigger picture move on the daily chart back up to 180. Now all of a sudden you could have a phenomenal risk reward on a deeper bounce back on that trade. So a lot of the ways that I like to approach markets is looking for smaller time frame risk to take advantage of bigger time frame potential reward. So the bigger time frame potential reward again is the snapback and Reddit, possibly to the ADMA on the daily. The smaller time frame risk is not buying back through yesterday's low versus today's low as the RDR trade is traditionally taught. It's looking for the smaller time frame trade where I can get an even better risk opportunity to be able to get some stock, and then if it's working out, not keep 100% of my position. That'd be too greedy because it's a counter trend trade. You're going to get stopped out in this a lot. But having, I don't know, depending on the situation, anywhere from 15 to 50% of the position to then look for the bigger move on the daily chart after the risk is covered. So that is what an RDR is. That's how it's traditionally taught. But that's how I personally like to trade it, which is a little bit of a difference. Yeah, so I already kind of, broadly spoke about the Chinese names, but my thought process is pretty much the same right now with all of them. Patience. I'm not looking to jump right back into these names right now. I want to be a little bit patient on any new longs, which might mean that I miss it, to be honest. But I don't like the market for this week unless NVIDIA comes in and saves it. Maybe if we had that big day 3 gap down in the Qs tomorrow, if the Qs can somehow gap down to 516 tomorrow, then maybe I'll come in and I'll say to myself, I've got to take a shot buying some of this stuff. But for the moment, I'm just gonna be patient. Whether it's the Chinese stocks or some of the longs that I got out of, like I'm all out of S. Look at that. It's S at 25. I'm all out of Path, which I got out at 15 quarter. I'm all out of Unity. Which hasn't really pulled back that much. I'm all out of Intel, which pulled back a bit, but not enough. I'm all out of Alibaba. I'm all out of JD. I'm all out of Yin. I'm all out of Tiger. Tiger, I'm not getting back into. I don't like it as much. So bottom line is I was able to reach my targets on a bunch of these names. I'm just being patient on re-entries right now. Specialty retail was up in general today. Okay, yep. RSP closed green, interesting. I didn't realize that. Do you have any thoughts on PCE set to release on Friday? I don't really. We just got to see what happens with the numbers. It's important, all the inflation numbers are important, but the market did an incredible job, but I think it was more market dynamic related at that time of absorbing a really hot CPI when it came out. And when the PPI came out, the read-through on that actually was that it was going to benefit the PCE, which is how we were able to get some further continuation, even though the PPI initially looked hot to me on the surface of it. The components of it actually were going to benefit PCE. So we'll see what happens. I do think, we spent a lot of time talking about this recently. Market dynamics are everything. It's the market dynamics that are the difference between the smaller dips being instantly bought back and those dips not being bought back. So right now we're in a little bit of a window this week, and this applies with the PCE, it applies with NVIDIA, where good numbers will create good reactions and bad numbers will create bad reactions, as opposed to in a different environment, you might get a situation where bad news comes out that can just be easily absorbed by the market because there's so much underlying demand from forced buying from systematics or the gamma or whatever. We are lesser in that environment now, so there is more room for us to be able to sell if NVIDIA has a bad reaction, if PC has a bad reaction. From Keen, I see you're in AMD. Obviously, NVIDIA is this week. SMH, 2 big down days. What's your take? So, my AMD position, just so you know, has been and still is very small. It's actually a little bit bigger now than it was, but it's still, broadly speaking, a pretty small position. SMH, 2 big down days in a row. AMD, even as I've been long, I keep talking about how terrible it looks and that it's not a long. But, the way that I trade is I put game plans on and I follow my game plans. And I follow my game plans even after I'm in the trade. If I think that the idea is wrong, I don't change my game plan. I stay with my game plan. I have learned over the course of my trading career that, let's say that I'm already in a trade and that trade is not looking good. You might say to yourself, wow, I could just exit this trade right now and save myself some money. I don't do that. I want the full loss. I would rather not save myself the money. And that's just because I have learned that I am not a perfect trader. And I know. I have learned that I'm not a perfect trader and that no one is a perfect trader. So, I just think it's better to just follow your game plans because it can be too easy to talk yourself out of trades. What I said in the morning meeting today was that we should just avoid trading any of the semiconductors until we get through NVIDIA's earnings. So that continues. That's my take. Let's get through NVIDIA's earnings and then let's reassess how the semiconductors look. It's just too much of a unknown risk factor that could lead to a move that's really big in either direction for these stocks. NVIDIA, I think, is fairly priced to perfection. I think that NVIDIA can't report. I think if NVIDIA reports inline numbers, it trades down. If it reports a miss, it'll get destroyed. But you can't count. But as I say that, NVIDIA was in the exact same situation as I'm just describing on several recent earnings reports and has always blown the numbers away to such a degree that you can't even deny them, right? And the stock, even if it's already priced to perfection, we've seen this thing so many times come in and report mind-blowing numbers that just rip the stock up. So you can't count the thing out. I think that the risk is to the downside, but you can't count the thing out. So given that, I just want to wait on semiconductors for doing anything new until we get through the report on Wednesday, and then we can reassess things on Wednesday evening, on Thursday morning, when we know what the numbers look like, we know what the reaction looks like, and take it from there. So that is my thought process on semiconductors, NVIDIA, AMD. Looks like I got through the VTF for the moment. So over on the YouTube, do you have a gamma update after Friday? I didn't see any new numbers, but the estimates that I had seen was that 60% of the positive gamma in the SPX was supposed to roll off. I'd also seen a couple variations on what that positive gamma number was, everything from like 8.7 billion to 11.1 billion. So let's just assume 10, somewhere in the middle there. So if you rolled off 60% of it, it still actually gives you positive gamma right now. So 4 billion, that can actually change based on how the market moves. So it's not impossible that number actually went down further as the market sells, but I haven't seen any updated info to give you on that. So just broadly speaking, based off of what I actually know, is that we're probably sitting as of Monday morning, as of this morning, somewhere around $4 billion of positive gamma, which is actually still a fairly insulating number. That's what I was saying at the end of last week. I was like, we're going to roll off from 10, 11 billion, but we're going to roll off to still a decently positive number. There was a time just somewhat recently where anything above 5 seemed big, and if you got to 10, it seemed like insurmountable. And now it seems like there's just so much vol selling that comes in that we just get right back up to that 10 number, and then the market can't move and we get the dispersion effect. So there still should actually be some insulation that's coming from positive SPX gamma, but a lower number can be overwhelmed. If you're getting $4 billion of buying that comes in from gamma and a 1% down move, but CTAs are forced to sell $4 billion in a down move, well, then they just outweighed each other. And I don't know exactly how much the CTAs are selling right now, but I do know that they are sellers into this down tape, and they're sellers into a down tape in a pretty decent way that might equal weight out actually that gamma. So just two kind of competing flows there. From Funny Shark, why Apple is moving up every day even though the market overall is going down and the macro environment is changing more towards bearish as government is cutting spending and unemployment is going to increase. I am short Apple. What should I do? I don't like the stock. It is a low growth stock with a 40 PE. Sure. So I agree with you on Apple valuation concerns. I have that as well because the growth has really been slowing down compared to what the multiple is. Uh, However, there's two things that you really want to consider. One is, and I've been saying it every day since it happened, I think that news with Alibaba on the China iPhones is a game changer. I think it's a game changer, the partnership that they now have to be able to bring AI to Apple iPhones as well. And the stock has traded as such. It's been the best looking, I think, of all the Mag 7 stocks ever since that news came out. And then the fact that it was able to consolidate up here and hold in further today is also pretty bullish. On top of that, we are in the open window for corporate buybacks. And Apple has the biggest corporate buyback in history. It's a bigger corporate buyback than the GDP of countries. It's insane how much stock Apple buys back. So it's always really difficult to fight any of these Mag 7 stocks, honestly, when they're in their corporate buyback window because there is forced buy flow that's coming in from the company itself. So I've been saying it every day. Apple, I don't think is the one to short. If you want to short, there's plenty of ones that don't look good right now. Tesla being first to the list. Tesla's awful looking. AVGO gave further downside continuation today. Microsoft lost that 407.50 that we were talking about that could make it shortable again. Amazon looks awful, though I wouldn't short it here. It's too downside extended. Google actually had some positive news this morning, but even with that, stock looks terrible and sold off. So, short the weak ones. If you're trapped long, what should you do? If you're trapped short, what you should do? Well, the first answer I'm going to give you is probably not the answer that you want, but I think it's a really important answer to give, so I'm going to give it to you anyway. What should you do if you're short Apple? You should follow the game plan that you created for yourself when you shorted Apple. And that game plan should have included risk management for if you're wrong. And then you should follow through with the game plan because game plans create consistency, and that's how you actually make money in this business. That's the first thing I would say to you. Second thing I would say to you is if you made a mistake and you don't actually have a game plan for risk management, you need to create one immediately. So create a game plan for how you want to manage risk. If it was my position, did it break yesterday's high today? 248.69. It did break it. If it was my position at this point, I probably would just use today's high as my stop loss for it, and pray that the market weakness continues. But it's hard to bet on that as we approach this degree of downside extension. Buy the ticket, take the ride. SMH hasn't led the market in months. If NVIDIA were to break out, that chart can easily lead us higher technically. Yeah, I agree with you. NVIDIA, I really do think is a coin toss. And it's wild that NVIDIA is happening at such a really important time for the market. Yeah. If you're talking about this Head and Shoulders going back to like October, I see it. I don't love Head and Shoulders patterns because I've seen them build out so many times and never actually trigger. And then when they actually trigger, the price that you're shorting on them is so hard. So I like to use head and shoulders patterns on a daily chart as more like a layer of probability for other information, other trades than anything. Because if this is a head and shoulders, it doesn't trigger till 220. And again, I've just seen that pattern build so many times. Like maybe it's doing right now, though it's kind of an ugly one, that just never ever triggers. And next thing you know, what you thought was the head high is breaking and the stock is continuing. So it's a long, long ways away from triggering on that. You do have a lot of strength there. You know, you need the market to pull back, I feel like, in order for this to work. And the market did pull back, and it still didn't work. So I don't know. I think that this is just not the best short of Mag 7 right now. It's the strongest looking stock. Ryan C is looking for Tesla 300. I love it. I love it. Let's get. I love it. I'm here for it. I don't have a position right now. I'm upset I never really got back in. I had an options position last week that made me a few bucks. Does DeepSeek get mentioned on the NVIDIA call? Yeah, maybe. Probably a question for tomorrow. Yeah, we'll see. All speculation. Yeah, you get market cycles. You know, ExxonMobil, biggest market cap stock in the world for a long time. All right, looks like I got through all the questions. Have a great night, everybody. I will see you all tomorrow.